Recording in progress.
Hi, Miguel, can you hear me? Hi, can you hear me? Hello, can anyone hear me?
Yes, I can hear you.
I can hear you.
Okay, thank you. Just wanted to do a check. Every now and again, I have intermittent internet sometimes, so if we get a little distracted, please just hang with me. All right, it's 6:30 now. How did everybody feel with the homework? I see I get everybody's still on mute, so I don't know if that means nobody attempted it.
I attempted it. I completed almost all up until I got to questions in the, I think it was 20 to 23. I think it was mainly because I'm trying to familiarize myself with the calculator.
Oh, okay, all right.
I just needed some guidance or clarity on how am I punching in those on the calculator.
Okay, what type of calculator do you have?
Well, actually, I don't have the physical one, but I downloaded the app until I get until the one I ordered reach. And it's on the Apple phone, the iPhone, but it's a financial calculator, but it have most of the keys are like the BA Texas Instrument, I think.
Okay.
But like I said, I haven't used the Texas Instrument calculator in a very long time, so it's just a matter of getting familiar again with it.
Okay, all right. Let me see something. I'm gonna go back to the top now and attempt to share the screen. I think, Miguel, are you there? Let me see if he has given me. Can you guys see my screen?
Okay. Yes.
Okay. Let me close on some of these. things here. All right, so you were having problems with questions 23.
That was questions. The ones with the multiple. Yeah, it was question 23.
Okay.
Oh, that one is that one is a little involved one. Uh, okay. What do you think you have to do in this question? Anyone?
Can you repeat that? I didn't hear you quite clearly.
I'm sorry. What do you think they're asking you for in this question?
The effective annual rate, interest rate.
Actually,
The present value.
exactly, yes. I don't know who it is that said it, but that is what they're asking for in this question.
Okay.
Sorry, yeah, sorry, I agree.
All right, the present value. All right, so let's step through it step by step. You are valuing an investment that will pay you $26,000 per year for the first 9 years, $34,000 per year for the next 11 years, and $47,000 per year following, and $47,000 per year the following 14 years. All payments are at the end of each year. All right, so before we go on to any further, so all right, you are valuing investment that will pay you $26,000 per year for the first 9 years. Okay, so going back to the present value tables. There, one other piece of information we know. Another similar risk investment is an account with a quoted annual interest rate of 9% with monthly compounding. What is the value of today's dollars of the set of cash flows you have been offered? All right, let's assume, let's assume that the required rate is 9%. Let's look at the first one, the 26,000 for 9 years, for the first 9 years. If I just gave you that, you are valuing an investment that will pay you $26,000 per year for the first 9 years. Assume a discount rate of 9%. How would you tackle that first question, that first part? Anyone?
Fine, you could use the table to find the factor.
That's correct, ma'am. What is the factor that you would be looking for?
In this case, it would be 0.460
I'm at a
and
single.
9%.
All right, let me on another computer. Yes, 9% for how many years?
9.
That's correct. So, and what table are you using, by the way?
The present value interest factors table.
That's-
C2.
Okay, I'm gonna catch up with you. Present value. Right, so 9% for how many periods? I mean, it's not a trick question, you're right.
No, I mean 9. Or in this case, would we use the present value of an annuity since it's a payment every year? It's per year.
Okay, good, good. That is correct, Bob. You are valuing an investment that will pay you $26,000 per year. As she rightly said, so you're getting $26,000 every year for the first 9 years. You are correct, ma'am.
Okay. So in that case, the factor would be 5.995.
Okay, so lead us through. So what will you do with the
I
$26,000?
use my calculator, so I'm just trying to do it by the table.
Oh, you don't have a calculator?
No, I used my calculator.
Oh, okay.
Yeah. Because for me, the question what gave me, I realized they were asking for the present value, but when I was not getting the right calculation, I looked at the answer and they were asking about the effective annual rate. So that's where I didn't pick up on that first part of it. So I got the cash flow portion of it, but trying to find the rate that you would use for the cash flow. Like it wasn't just a simple 9% divided by 12. You had to find the effective annual rate. So for me, I had to figure, okay, so if a question is presented, how would I know, what clues would I pick up on that is not just simply 9% divided by 12, but you actually have to go further to find the effective annual rate.
And this is for this question, number 23, the answer for 23. Are you sure you're reading the right answer, ma'am? I'm only asking because
23? Yeah.
Okay, let's do it step by step in this. Does anybody have a calculator that they can calculate something and store it?
I can use my calculator. I have a calculator.
So let's work with the factor, because I'll tell you the God's honest truth. I haven't done the answers myself.
Oh.
Right? Okay, so I mean, I sent you on the answer sheet too.
Yeah, you did.
What? Let me see something. Maybe I opened up the wrong one. Sample problems, solutions. Let me see how I'm in the right one now. I see what they said. Hold on 1 second. 26,000 per year for the first 9 years. Another similar other is account with a quoted annual rate of 9%. Okay, with monthly compounding of interest. Okay, I see what you're saying. Number of compounding rate, I equals 0.79% annually divided by 12 compounded in 1 year periods. Present value equals 100. Solve for future value. Answer 109. Subtract, okay, I see what they're saying. Okay. Please forgive me, I did not look at the answers. Do you understand what they're saying? Even if the appropriate annual discount rate, what is the value of the investment? Number 23. 9% with monthly compounding. So in order to find out the real discount rate, you have to then take the 9%, as she stated, and find out what is the effective compounded annual rate yield. The way you do that is divide the 9% by 12 to find out what is it monthly, or better yet, go to the interest factor tables, right? Look at the future value. Of 9% for 9 periods. For 9 years. 9 years would have how many monthly periods in it?
That's 108 monthly periods.
Right. But how they're doing it this way is they're doing $1. They're using 100 as a factor. And what they're saying, 9% divided by 12 periods in 1 year. Solve for factor 109. What 9 is future value of an interest factor. How many periods? Is it 9 times 12 is how many periods?
108.
All right, so my tables do not go up to 108. But hypothetically, what you would do in the factor table, you would find the 9% compounded no, it'll be, let me see. It'll be dividing 9 by 12 give you an interest factor of how much?
Nine divided by 12 is 0.75.
0.75. You see, you would have to have a calculator for this. It is too involved manually, because what you would do, what type of calculator do you have?
I have a business calculator.
Okay, so what you'll do, the I factor, you would then put in 9 and divide it by 12. Am I correct? How does your calculator work?
Yeah, I could put in 9 divided by 12. Yeah.
And then whatever that answer is, which is 0.75, you hit the I button for the interest factor.
Mm-hmm.
Then the number of periods, you would then take 9 times 12. Whatever that interest is, that'll be N. Correct?
I'm doing 9 by 12.
Yes. Is it first 9 years, right? 9 times 12 is 84, right? Well, no,
Yeah.
no, I'm sorry.
So 9 times 12 is 108.
Okay, 108, that'll be your N factor.
I thought we doing the number of compounding periods in 1 year to find out, because we
Yeah, yeah.
calculated the interest at per month, per month. So we wouldn't use N as 12?
No, because whatever you do to the interest factor, remember you took the 9% and divided it by 12, right?
Mhm.
To get 0.75, right?
Right.
Whatever, when you divide the interest, you then have to, for these, you then have to multiply the number of years by 12. You divide by 12 for the interest factor, and then multiply by 12 for the number of periods. Does that make sense to everybody?
I'm just trying to come back to how with the solution, because the solution they're using the 0.75 as the interest factor, but 12 periods, but meaning compounding periods in 1 year to find the effective annual rate. And then that's the rate they would use to find the present value for those each set of cash flows.
Okay.
Find out how to go through it, how you're doing it. So
okay, that's fine. I could do it that way to find the factor. I see where
we
you're
can do it both ways. I just trying to follow you. I'm trying to figure out.
I have to make sure that you understand. We could do it, let's ignore the question for this instance, and they find out it's N equals 12. So if you divide, I can work with that now. So if we're finding the interest factor for 1 year, then we'll apply it to the whole 9 years, not a problem. Okay, so the interest factor is N equals 12. You divide I by 12 to find out the N is the number of periods, divide the interest rate by 12 to find out what is basically the interest rate factor. The present value is 100. They're doing a hypothetical present value. So solve for future value, it's just 100. The answer should be, we could actually go back to the tables if we're going to do it this way. Let me see something. Interest rate factor table for future value, 9%. 9% for 1 year is 1.090. So fine. Interest rate factor for 1, that's the effective rate. All right, so I don't want to belabor that. So I agree with you. You can do it that way because the interest rate factor table does not go up all the way to 84 periods. All right, so we know that the effective rate is 9.3807. I'll go by that. I don't want to lose anybody here. Does everybody understand, and quite correctly, what they did? This even helps me in terms of my interest rate factor table because I don't go. All you need is the interest rate factor for 1 year, and then you can modify it. So, does everybody understand how they got to the 9.3807? My interest rate factor table does not go all the way up there to all those places. They rounded off at 1.090. Does everybody have a feel on that? What they did, rather than looking at the whole 9 years, they looked at 1 year just to find out the interest rate factor table. Now they're going to apply it to the whole present value to discount all those back now that they have the interest rate factor for all those years. Am I making sense to you guys?
So far.
Okay. So let's work this through. Now calculate the present value of the cash flow using the ERA as the discount rate. So 20 cash flow one is 26,000. Do they have a factor? Can someone look at the interest rate factor table for the present value at 9.38%? And it doesn't seem, my interest rate factor tables don't have 0.38%. Present value factor table, they just have a 0.4 or something like that. ERS discount rate. So the answer, net present value, is 314. So what they did hypothetically, and does anyone, my dear, do you have the calculator? Who is the young lady with the calculator?
The business calculator?
Yes.
I do.
Okay, so
Hello?
I think his internet dropped off, maybe power, maybe.
Oh, I see a few people already dropped as well.
hi, I think I lost you guys there for a second. Can everybody hear me? Hi, are you still there? Okay, I'm sorry. Like I said, I was having internet connectivity issues. That's one of the things. Okay. What I want to do, if you'll bear with me, because that problem is a very involved problem, you won't have something like that on your exam because that'll absorb too much of your time, and it has to be done on a calculator. what I would like to do, because we're already at 7 o'clock, let me get through today's work. And then at the end of the class, if there's still time remaining, I'll loop back to that. Is that okay with everybody? Because I don't want to get involved with that. And I find that at the end of the day, our time has run out.
Okay.
Okay? So bear with me a second here. Can you guys see my screen as yet?
No.
Not as yet, no.
Okay, hold on one second. Let me get lined up again. Okay. Are you guys still there?
Yes.
All right, so okay, I'm going to share my screen again. Share screen so we can pick up where we left off. Okay, I need, because time runs out very quickly on this. So and I don't want to get to, if need be, I will schedule, if you guys are of the mindset, we can schedule a Saturday class where we can go through all of those things. I'll fully give that of my time, but I need to get you guys through. Okay, today we're going to look at savings and investment products, specifically fixed income equity derivative products. Can anyone tell me what a fixed income product is? You guys can't hear me, right? Hello?
We can hear you. I can hear you.
All right, all right. I'm sorry. Every now and again, I just need to check because of my internet being sketchy. Okay, basically your fixed income securities are basically securities where you basically understand that there is a fixed amount that you can basically count on. These primarily take the form of bonds, certificates of deposit, and treasury bonds or corporate bonds. As reading through it quickly, fixed income products involve a lender of money and a borrower of money. The details of the contract between the lender and borrower is what defines a given fixed income product. Going forward, we will refer to fixed income products as bonds. That is the most popular type of fixed income product. But there are various types. I'm just saying going forward, they'll just refer to it as bonds. Certificates of deposit, a debt instrument issued by a bank that usually pays interest
Maturities may range from a few weeks to several years. Interest rates are set by the competitive forces in the marketplace. Treasury bills, a short-term discounted government security sold through competitive bidding at weekly and monthly auctions in denominations of 10,000 to a million. Can anybody give me an example? Do we have those in the local market? Do we have CDs in the local market?
Yes, we do.
All right, they have normally the bank CDs. Do we
Yeah.
have treasury bills in the local market?
Yes,
Who issues the treasury bill?
central bank.
Whoa, that's correct. Normally, what is the time period they issue a treasury bill for here in our local market?
1 year.
Actually, not in this instance.
It's less.
Yes, treasury bills, as the term denotes, short-term discounted. They can go up to a year amount. You're absolutely correct. But what I've seen in our local market, they normally do 90-day and 180-day treasury bills. Okay, excuse me one second. All right, has anybody, normally the treasury bills being offered, you'll see them in the papers. The central bank issues a notice. Also, you can actually go onto the central bank website and you will see where they have bonds and treasury bills. You can look at them and they will tell you what's been offered of late and what has been the going rate. I am going to try and remember to make a mental note to send the class a copy of the latest government treasury bill offering. Treasury bonds. Treasury bonds is a marketable fixed interest government debt security with a maturity of more than 10 years. And the bonds make interest payments semi-annually. Treasury bonds are issued with a minimum denomination of 1,000. They are initially sold through auction in which the maximum purchase amount is 5 million if the bid is non-competitive, or 35% of the offering if the bid is competitive. What they mean by non-competitive means that the central bank just goes ahead and sets the rate on the bonds. Competitive means they put it out to bidding, and the highest bid they receive becomes the interest rate that will be paid on that bond. A competitive bid states the rate the bidder is willing to accept. It will be accepted depending on how it compares to the set rate of the bond. A non-competitive bid ensures that the bidder will get the bond, but he or she will have to accept the set rate. After the auction, the bond can be sold in the secondary market. Corporate bonds. Corporate bonds often pay higher rates than government or municipal bonds because they tend to be riskier. The bondholder receives interest payments and the principal, usually $1,000, is repaid on a fixed maturity date. Generally, changes in interest rates are reflected in the bond's prices. Bonds are considered to be less risky than stocks, since the company has to pay off all its debt before it handles its obligations to stockholders. Corporate bonds have a wide range of ratings and yields because the financial health of the issuer can vary widely. So let's take, for instance, the government issues a bond, a 5-year bond, and it's paying 5% on that bond. If Kelly's, y'all know Kelly's, all the women know Kelly's, right?
Yes.
If Kelly's was to issue a bond too, same maturity date, what would you expect the interest rate being paid on that bond to be, higher or lower than the government interest rate?
I would say high if it's considered to be more of a risky investment.
That's the answer I was looking for. Municipal bond. Does everybody understand that before I move on? It makes sense, right? I mean, even though some may consider Kelly is more stable than the government, it isn't. Municipal bond, a debt security issued by a state, municipality, or country in order to finance its capital expenditure. So let's just say, in our instance, you know how we have they always pushing for local government around here, meaning every island has its own local government. All right. Let's just say the central bank issues a bond by the overall government. But Andros issues a bond specifically for development that's happening in Andros. The local government of Andros issues a bond. So you have the central bank issues a bond, then the local government of Andros issues a bond. Which one is a treasury bond and which one is a municipal bond?
The central bank will be the treasury bond,
That's correct. And Andros will be
the municipal.
right. I'm just trying, I'm reaching here to give an example, you know, because the Fed issues treasury bond. Then a state, say the state of Florida, issues a bond. It needs to fund specifically its road development or road upkeep. And it's only levied on the residents of Florida. Or the bond is 9 times out of 10, bonds can only be bought by the residents of the state. But again, real picky. I just want you to understand the difference between a government issued bond and maybe a municipal or a local government bond. Bond ratings, a measure of the quality and safety of a bond based on the issuer's financial condition. More specifically, an evaluation from a rating service indicating the likelihood that a debt issuer will be able to meet scheduled interest and principal repayments. Typically, AAA is best and D is worst. The key bond rating agencies are Standard & Poor's, Moody's, and Fitch. They assign the following rating. Standard & Poor's and Fitch, they use AAA, AA, triple B, and so forth. Moody's does another thing. Is anybody familiar with those ratings? And can somebody tell me if they apply in our local market?
I usually see it at the end of the news report. I think the 7 p.m. news, they mention S&P. Will they reference or they highlight what's going on the market for that day? So I would think it has something to do with us.
Well, yes and no. Okay, maybe I asked the wrong question. But let me tell you what I was getting at. I don't know if now and again you see where the government bonds on the international market, S&P and Moody's rate the government debt in terms of the international market. And sometimes you will see where the government bonds have been downgraded.
Yes.
Yes.
Yeah, you're familiar, you've seen that, and you've heard on the debate on that. Am I
Right.
correct?
Yeah.
Okay, so these are the same agencies that rate the government's bonds on the internet as if an international investor, because the government, an international investor was going to invest in bonds issued by the government of the Bahamas. In most instances, the rating isn't for the local bonds, the $B denominated bonds. There is a rating for what they assign for what the government also borrows from other countries in foreign currency. So they're giving an indication to the potential foreign investor what they deem is the financial strength of the government. All right, so let me read on. Investment grade. A bond which is relatively safe, having a high bond rating of BBB or above. All right. Junk bonds. A high risk, non-investment grade bond with a low credit rating, usually BB or lower. As a consequence, it usually has a high yield opposite of investment grade bond. Now, I don't know who was the young lady that answered, yes, she was familiar with it. What is the government of the Bahamas bonds currently rated? Are they investment grade or junk grade?
Junk.
Pardon me?
Junk.
Okay, you're correct. Now, what does that tell you? Is it because the government of the Bahamas is high risk and defaulted before, or what? What does that mean to you? Anybody? Okay, let me jump in here. What it means is that the rating services have looked at the government financials. Remember, the government every year posts its financials, whether they're making money or whether they're, you talk about the GDP and the national product. First of all, the government of the Bahamas has never defaulted on the repayment of any of its bonds, principal and or interest. In this instance, Moody's is rating the government basically on the outlook of the economy. Because the government only way of actually raising funds is through taxation. If the economy is weak, then they're going to raise lower taxes. So what they're looking at isn't only whether the government has paid in the past. They're looking at what is the financial health of this country. And therefore, you should be cognizant if the financial health of the country is in question, then they try to give a forewarning to potential investors. Hey, you better be aware of some things. Like take, for instance, we got a downgrade, particularly during the time of the pandemic, the 2 years of the pandemic. Because basically our economy had come to a standstill, tourism wasn't going and so forth. So they were saying, the investment agencies were saying, or the investment rating agencies were saying, hey, tourism is their mainstay of income. Y'all better be careful of investing in any bonds that the government of the Bahamas may issue. It isn't because the government defaulted and they never had defaulted. It's because they're based on past history and also looking into the future. Key features of fixed income securities. Term to maturity, the number of years over which the bond issuer has promised to meet the conditions of the contract. Maturity date. I'm going to digress here for a second because I just want to show you guys something. Okay, here is a prospectus. When the government, this happened in March 22. This is what the notice the government puts in the paper when it's getting ready to issue bonds. Issuer is this. Can everybody see my screen?
Yes.
Yes.
Good. Here's a prospectus. This tells you that the government is looking to raise $10 million. It's going to raise it in, here's a 3-year offering. They're looking for 2 million, 5-year, 1 million, 7-year, 1 million, so forth and so on. It gives you the interest rate that's associated with their bonds. As you can guess, the longer the maturity, which is a 30-year, the higher the interest rate. It gives you the maturity date. So this 30 years maturing on March 15, 2052. Interest payment is semi-annually. All right, let's look at some other salient features. Bahamas government is the issuer. Central Bank of the Bahamas is a registrar. The organizer is the Central Bank of the Bahamas. The minimum investment is $100, and you can then invest in increments of $100 thereafter. So first of all, you got to invest a minimum of $100. Second, every additional amount you want has to be in increments of 100. So in other words, I can't go to the central bank and say I want $150 worth of bonds. It got to be 100, 200, 300, and so forth. The opening date of this prospectus is 8th of March 2022. The close date is the 10th of March 2022, settlement 15th of March. First interest payment, 15th of September 2022. So March is the third month, September is the ninth month, 6 months. The way they calculate interest on accrued is actual number of days of 365. Instructions for participant, application, complete the electronic format. So they tell you how to do it. They tell you the KYC documents that they need, and they tell you how to make payment to the central bank. Bank wire information, or you can pay in the central bank digital currency $sign information. Other things, securities will be awarded in accordance with the central bank's priority-based auction allocation. So they tell you how they're going to do it. All allocation with first priority given to individuals applying for 250,000 or less. In other words, in order for individuals to be able to avail themselves of the bond, because you have a lot of professional money, such as pension plans, insurance companies, banks, who also buy government security. In order for the small or the retail investor not to be crowded out, the government is saying, I am going to fill all these individual retail investors' applications first. Then what's left, I'll give to the professional money managers. All other applicants, individuals greater than 250,000 and institutions will be classified as priority level 2. Allotments may be prorated as needed depending on the total value of the subscription. The central bank reserves the order to grow or shrink this. In other words, they're asking for 10 million, but by the time they get the auction, they may say, okay, no, I really need 15 million, so they could grow the offering. Or depending upon the number of people who are wanting it, they may say, okay, we're doing 10 million, but hey, I got applications totaling 20 million. I can take the 20 million. All right, so these are the salient features of what happens. Then there's the discontinuation of public brokerage service. That's a notice that came up that caused a lot of panic in the market for a short time. But let me go back. So I just showed you some term to maturity, maturity date, par value, trading at a discount to bond prices. Okay, so these bonds are going to be issued at par, but there are times when the bond is trading at a discount. In other words, instead of paying $100, they may be offered for $99.2. Now, if it's trading at a premium, that means it's being offered at higher than 100. But normally in the initial public offering forum, the IPO, bonds are normally issued at par. These probably trading at a discount and trading at a premium is when the bonds enter the secondary market. The coupon rate, the interest that the issuer agrees to pay each year. I showed you that. Zero coupon bonds. These are bonds that do not pay coupons, but they usually trade at a significant discount to par. Zero coupon bond is when an issuer issues a bond with the understanding that I need to raise, you give me your money, give me $100. Or better yet, no. Give me $85. Lend it to me for 5 years. At 5 years, instead of paying you back $85, I'll pay you back $100. Now, in the interim, they don't pay any interest. Variable or floating rate notes, the coupon is linked to a predetermined interest rate benchmark, and as the benchmark interest rate changes, the coupon is reset. Now, the central bank, the thing that I showed you, they're all fixed rates. They're not variable rates. In the past, the central bank has issued some variable rates, and they're normally tied to prime at some discount or premium above prime. But they haven't issued a variable rate for a very long time. The buyer of a bond takes accrued interest. The buyer of a bond takes ownership as at a given date, which is usually between coupon payments. When the next coupon payment is made, the new bond owner gets the entire coupon, despite the seller having owned the bond for a portion of the period since the last coupon payment. Since the seller of the bond is owed the interest earned between the last payment date and the sale date, the buyer must pay the seller this accrued interest. Who understands that?
I do.
Any- You do?
Yes.
Explain it to us, please.
Say if I want to sell my bond to you.
Yes.
The bond has already paid interest at some point during the year. So in order to purchase the bond, you would have to pay me the
Yeah.
interest that would have accrued between when the bond last paid interest and if we're gonna buy or if you're gonna buy it as of today. So if the last paid interest April 28th, you would have to pay me the accrued interest from April 28th to May 5th.
Okay, you are absolutely correct, but I'm gonna ask you to please be patient. And can you see my screen?
Yes.
Okay, give us an example using what I have up on the screen. Okay, let's just say this bond was issued in March 15, 2022. You bought $1,000 of this bond on March 15, okay?
Mm-hmm.
The next interest payment is the 15th of September, right?
Mm-hmm.
But let's just say in June, you run a little short, a little tight, you know, school fees or something, and you needed to sell your bond in order to make it. What would you be entitled to? You tell me, how much interest would you be entitled to? You bought it on March, the next payment is September interest, but you needed to sell it in June.
We're gonna just take the first one for example, the fixed interest on of the 3.6.
Yeah, that's fine, that's fine. I don't really need
Okay.
I don't really need the mathematics. I'm just talking conceptually. You're gonna sell it, you bought it 15th of March. The next interest payment is September the 15th. You decided you needed to sell your bond, say June 15th, just to make matters simple.
Mm-hmm.
What would you be entitled to, if anything? Would you be entitled to any of the interest?
Yes. Me as the seller?
Yes.
Yes.
Okay, explain to me, what would you be entitled to?
I would be, when did you say last paid in February?
No, March. It was just issued in March, 15th of March.
Okay. I would be
You paid it
entitled.
on June 15th. The next interest payment is 15th of September.
I would be entitled to interest from March 16 to when I'm selling it in June. Because when the next payment, once the next interest payment comes up in September, the owner, according to the central bank, would be yourself, and they would pay you the full amount of the interest from March to September, but you did not own the bond for the entirety of that interest payment. That's where the payment, that's why you have to pay me for the portion that I was entitled to.
Okay, you take over the class. Because you got it. Does everybody else understand that? I just don't want one person understanding doesn't make sense. There's a logical thing where they're trying to be equitable. So I'm entitled as the seller. I held the bond from March 15th to June. My money was tied up. So
Correct.
I am entitled to interest on for the time period my money was tied up. Now, however, the central bank don't care about none of that. They can just look on September the 15th, who's the owner of the bond?
Correct.
And they can send the entire coupon payment to them. Whoever is the owner of the bond of record. But the buyer of my bond is really not entitled to about 3 months interest because they didn't hold the bond for the entire period over which interest is being calculated and paid. But okay, excellent, excellent. Anybody else? I mean, y'all making me feel like everybody in here are awake in my class. Good, okay. Callable
Yeah.
bond.
I have a question. When she sells the bond in June, she can inform the central bank for them to make the change?
Yeah, the central bank, you gotta sell the bond and the central bank has to be notified, okay?
Okay,
Of who is the owner, okay?
okay,
Because they are, if you go back to this thing, the central bank is the registrar. They hold the books. What that mean? They're the registrar and transfer agent. They the people who log who owns the bonds, okay?
okay.
So when that happens, yeah, my name will go on and owning the bond. But the central bank ain't gonna everybody go calculate, okay, can have the interest for 3 months. Then someone else had the interest for 3 months. No, they ain't care about that. Whoever owned the bond on September 15th, send the coupon to them, let them go wait till the rest of it.
Mm.
I mean to be cold, but that's basically y'all will go amongst yourselves, okay? A callable bond. Sometimes issuers of bond issue bonds with a callable feature. What this means is they have the right to call the bond at specified predetermined dates which they disclose. For instance, why would they call a bond? Anybody could give me an example why an issuer, after the issuance, would call the bond to say, I'm retiring this bond. Why would they do that? I know this is a bunch of smart people, most of you on the computer and everything like that. Now, come on now, you're being bashful. You're tired today.
We here.
All right. Tell me why would I want to call a bond?
I think, not sure, but I think a reason could be if you're paying out more interest than you're earning, or depend on the interest on the market, and if you can pay off the principal, so you no longer have to pay annual interest or semi-annual interest to bondholders. That's what I'm thinking.
Okay, yeah, almost there, but anybody else? Come on, guys, y'all stay with me. I know it's late now. Come on now, but y'all stay with me. We only got an hour. Then you all can go watch all your reality shows. Okay. Suppose when I issued the bond, I'm issuing a fixed rate bond. I'm locked in at 5% because that was the interest rate structure for that bond, for the 3-year bond I was issuing or whatever. But I write in an option where I could call the bond in the year. Now, it's getting on to this call date. And I look at, okay. Well, I see interest rates going down. So me, being Mr. Smarty Pants, I can say, you know what? I can call this bond that I paying 5% on. Get the money, pay out the money, and then I can offer a new bond, but I only paying 3% on the new bond. In other words, the incentive for me calling that bond is I can refinance that now at a lower interest rate that I pay out as the issuer. Okay? That makes sense to everybody?
Yeah.
Okay. That's one factor. The other factor, it may be like, hey, my earnings were so tremendous, rather than me just paying out these earnings and dividends, let me retire some of my debt. The key risks of fixed income securities. Interest rate risk. Bond prices are inversely related to interest rates. So if interest rates increase, then the bond's price will decrease. Now, who can explain that to me? So in a nutshell, this normally applies when bonds are trading in the secondary market. Let's just say me as the bondholder, when I bought the bond, it was paying 5%. I mean, 5 years ago, it was paying 5%, all right? Now, 2 years later, my bond has how many years remaining on its life? Anyone? When I bought it, it was a 5-year bond. 2 years have elapsed. How many more years have I left on this bond?
3.
3. When I look at the paper, I see new issued 3-year bonds are now paying, a person is offering a bond, a 3-year bond, at 6% to the marketplace. What do you think is going to happen to the price of my bond at that point in time? Just a listing price. I'm not saying I'm going ahead with the sale, but if I wanted to sell it, am I going to probably sell it at a premium or a discount or a pound?
What was the rate when you bought it again?
5?
What was the rate when you bought it? It was less than 6?
No, it was 5% when I bought it. 5 at year 1 when it was a 5-year bond.
Mm-hmm.
2 years have elapsed now. And so my bond has a 3-year life remaining on it. In the marketplace, people who are issuing 3-year bonds are now paying 6%. So if I wanted to sell my bond that I bought,
Mm-hmm.
am I likely going to sell it at a premium, discount, or at par?
Discount.
Why?
Because what someone can get for a 3-year bond, they can get 6% versus you're selling if you were to sell, it would be 5%, I would be getting less.
You got it.
I would want to get a discount off of because I could get something more if I go.
Well, the discount makes up for that variation or that change in the interest rate. The coupon on my 5-year bond cannot change. That is 5%.
Mm-hmm.
But the question is being asked, let's just say $100, right? Paying 5%, that's $5, right?
Mhm.
Now the question that an investor would ask is, bro, I could buy this bond here and get 6% on my $100. So I then come back to you, you gotta give me a little discount on this, man, in order for me not to be. So what I gotta find out is 5% is 6% of what price? Does that make sense to you? Or $5. $5 is 6% of what amount? Probably be like $95 I'll have to send the bond to. You got me?
Yeah.
Okay. Call and prepayment risk. The risk that bond issuer will refund the principal in a low interest rate environment. Remember we talked about a callable bond? Well, that's the risk a purchaser of a callable bond runs. Yield curve risk. The yield curve can shift both in a parallel fashion and by rotating. The extent that either of these types of shifts can negatively impact a bond portfolio is called yield curve risk. I mean, rates go up or down. Reinvestment risk. Risk that proceeds must be reinvested in a low interest rate environment. Okay, what does reinvestment risk normally apply to? So when people are calculating the yield to maturity, right? They normally calculate it assuming that the yield curve, what we just said, will remain the way it is over the life of the bond. So when they say, if you bought a 5% coupon bond, and you know that, and you assume that the rate is going to be the same over the life of the bond, is assuming that all the interest you receive can be reinvested at 5%. That's the reinvestment risk. Normally, rates change, particularly over a 30-year bond. Rates ain't gonna stay the same. They could go up or they could go down. So your yield to maturity, depending upon how rates shift, can be higher or lower than the original yield to maturity, which was always equal to the coupon on the bond. Credit risk. Risk that the issuer of a bond either default or is downgraded. We just talked about the rating agency. Liquidity risk. Risk that the bond holder will need to sell the bond at a discount to its true value. Remember, I just painted the example. You bought it in March, but school fees came up. You got to sell it. Well, if interest rates have changed, you may have to sell that at a discount. Exchange rate risk. When investing in bonds issued in another currency, there is the risk that the home currency depreciates versus the other currency. Meaning, all right, you live in the Bahamas, you bought a bond that's denominated in British pounds. The British pound may go down against the dollar. So when you get ready to convert it back, you may be converting less. You will be getting less in dollars than what you originally paid, or to pay for British pounds and so forth like that. Inflation or purchasing power risk. Risk that rising inflation reduces the real rate of interest earned on a bond, thus reducing the buying power of the proceeds received. All right, let's just say right up and now, because of the war going on between Ukraine and Russia, Russia, who is one of the leading world providers of oil, has started to cut back on the amount of oil that it is producing and selling. So, or the countries who have sanctions against Russia isn't buying as much oil from Russia. That means the price of oil goes up. Oil is related to everything energy related. So 9 times out of 10, somewhere along the line, guess what's gonna happen to your electricity bill? Anyone? Your electricity can go up. Y'all still there with me, right? I'm not talking to avoid.
We're here.
Okay, I haven't lost connection, just check. Because BPL buys oil to produce energy and electricity. So if they gotta pay more for the oil, guess who they can pay, guess who they can pass that on to? You guys, the consumers. So last month, you were paying $150 in the electricity bill. This month, you're paying $200. Your purchasing power based upon your income has gone down. Event risks. External shocks that reduce or eliminate the issuer's ability to meet its obligations. Let's just say a country was going along well. And we sit in the zone that could cause us external shocks. What am I talking about? Hurricane. We've already seen where hurricane has wiped out Abaco, has wiped out Freeport. Now suppose that was Nassau or even something that got wiped out, God forbid that. That obviously, that's a natural catastrophe. Nobody has any power over that. But that will reduce the government's ability, because if you get shut down, no tourists coming here, we got to rebuild the country. For that period, hey, you ain't getting no revenue coming in. On pricing, quoted pricing, dollar amount. As you know, bonds are sold at what they call par or as a decimal factor 1. Anything below that is a decimal factor that's 0 point something. So a quoted price on a bond of 98.25 means that the price on it is 0.9825. Par value is 1,000. So the dollar price is $982.50 as opposed to 1,000. Quoted price 103.5 as a decimal factor as 1.035. Par value of 10,000. That is, the price on that is 10,350. Of those two examples, which one is a discount and which one is a premium?
98 is the discount and the 103 is the premium.
That's correct. Quoted price, 110.75, $110, well, 110.75. Price per dollar, 1.1075, 100,000, 110. So y'all get the gist of it. Whatever that price factor is, turn it into a decimal. 110 and 3/4 mean that 110.75. Take that price and divide it by 100, and then you get the decimal factor. The relationship between price and discount rate. The graph below shows the relationship between price and discount. Which axis do you think is price and which is the discount rate? Well, obviously they've already shown it. Price is on the left axis, on the x-axis, and discount is the y-axis. All right, so this graph shows the relationship is not linear but convex in nature. Who's going to be brave enough to try to explain that one to the class? Anyone? Well, it shows basically the price change. The larger a movement in price, the greater is the change in the discount. Or the greater the change in interest rates. No, a change in interest rates normally brings on a greater change in price. What do I mean by that? If rates go up by 1%, normally the price of a bond will react in a greater than 1% change, relatively speaking. So suppose interest rates change from 5% to 6%, they go up. Normally, as you know, bond prices and interest rates have an inverse relationship. But what this is saying is a change. What is the magnitude of the change in price as a result of a 1% change in interest rates? Normally, the price change is greater than 1%. Okay? So it's a convex, it's not linear. Linear would have been a 1% change in prices, a 1% change in interest rates would bring the same 1% change in price. It's not that. That's a linear relationship, 1 for 1. Normally, in a convex relationship, you find that one factor changes at a greater rate as a result of a change in the other factor. That leads into the concept of duration. I want you all to understand this. You will not see this on the exam. I promise you that. How do I know that? I got to send the questions on the exam. Duration is a measure of the approximate sensitivity. Now, I may ask you for the definition in a multiple choice. I will not ever ask you to calculate it. It's too involved. But I want you to understand the concept of when they say, give me the definition of duration. Duration is a measure of the approximate sensitivity of a bond's value to rate changes. More specifically, It is the approximate percentage change in value for a 100 basis point change in interest rates. 100 basis point, when they're talking about rates, rather than talking, sometimes they may say a 1% change in rates. Other people may say that's 100 basis points change. 1% is equal to 100 basis points, okay? When you're talking about bonds and rates. So let's go over that again. Duration is a measure of the approximate sensitivity of a bond's value or bond's price to rate changes. More specifically, it is the approximate percentage change in value for a 100 basis point or 1% change in rates. While we are not going to calculate duration in this course, the reader should note that the duration equation is linear. In the chart above the straight line, well, they didn't do a straight line. So here, a linear means going straight. You could have almost anticipated once the relationship is established. That makes it linear. In the chart above, the straight line above the straight line that just touches the curve is called a tangent line because it just touches the curve. This line, guys, I can skip these two, you will not. Just understand what is the definition or conceptually what is duration. Duration measures the sensitivity of the change, the percentage change in a bond's price as a result of a 100 basis point or 1% change in interest rates. That's all y'all gotta know. Principles of valuing a bond. The present value of a bond is based on taking all of the future cash flows of the bond and discounting these cash flows at a given discount rate of interest. The present value of a bond is based on taking all of the future cash flows of the bond and discounting these cash flows at a given discount rate or interest rate. Would that remind you of anyone? What recent exercise we did?
Exercise we did last.
Go ahead. Go ahead, please. Somebody started and I may have rudely cut them off. I think you were right, if you're being bashful enough. We recently did an exercise that was almost there. Remember at the beginning of the class, we were working on problem 23?
Yeah.
And the first problem, the first part, where you had the 26,000, and we had to go find those. Technically, what we were looking at is taking those 26,000 per year for 9 years and discounting them back to the present value to find out what the value would have been. Eventually, when we finally answer the question, that's what it's going to be. Same thing happens with bonds. Let's assume we have a bond that matures in 5 years and pays its coupon annually. Also, the bond's coupon is 10% and the discount rate is 9%. What is the present value of this bond? Okay, let's go back to the tables. I think we can do this one real quickly. Okay, so the present value, let's assume we have a bond that matures in 5 years and it pays its coupon annually. So we ain't got to worry about the months. So if you had a bond for 9 years, for 5 years, and it pays its coupon annually, I want somebody to tell me what factor table would be used. First of all, is this we're trying to find valuation of the bond at today's rate. Is this a future value, present value problem? What?
At today's rate, it will be a present value.
Great, excellent. Is this the present value of a lump sum or the present value of an annuity?
Lump sum? Is it? Well, no, because it's paying a coupon. So annuity?
Exactly, it pays a coupon annually for 5 years. That's 5 equal annual payments. So it's an annuity,
Right.
right? But the person who said a lump sum is also correct to a certain extent. Which one is the lump sum payment?
Yeah, 5 would be the lump sum.
When you are supposed to get the principal.
30.
Yes. So the coupon rate is a stream of an annuity. But the final reimbursement or payback of your principal, that is a lump sum. Everybody understands that?
Yes.
Okay, great. So basically, without going into the figures, you will find out the factor for the 5 years. It could also be $1. I mean, because or whatever it is, the amount is, what you will have to do is go find out the coupon rate. So let's just say you had $100 that you invested for 5 years at a coupon rate of 10%. So if you had $100, 5 years, what is the coupon going to be on $100 at 10%? $1, or is it $10? $100 at 10% for 1 year. What is the interest rate? What is the interest you earn? Come on,
Oh.
100 times 0.1. What is that? $10, right?
Yes.
Okay. So you find the interest factor for an annuity at 9%. The discount rate is 9%. You just be very careful about that. The coupon that you get, the dollar amount is 10, but the discount rate that you're going to be using is 9%. So you look at the column 9 of the present value of an annuity factor table. You look at 9% for 5 periods. You find that factor. Then you multiply it by the $10, by 10, which is the $10. You find that factor. Then you go to the table, the present value of a lump sum. Take the $100, find the factor of 9%, 5 periods, take that factor and multiply it by the $100. That is what is the present value of $100 you will get 5 years hence in today's value. You add those two amounts together. Here. So really all bond is a pricing a bond is a present value exercise. That's what I'm trying to get at. Everybody understands that?
Is that why the price is lower?
Yeah,
Can
I
you
mean,
explain first.
whenever you say present value of a future lump sum, the present value of a future lump sum is always lower than what it's going to be in the future. What you are
Assuming
trying,
things go up,
pardon me?
assuming the variables increase.
Yeah, I mean, the rates can increase then, yes, you have a point there. All right, so rates play a portion in it, but normally it is going to be lower than what you're going to get in the future.
Mhm.
And so remember the hypothetical argument when I said I bought a bond, originally it was now, I originally bought it for $100, a 5-year bond. I bought it with a coupon paying 5%. 2 years thereafter, I now want to sell the bond, but the interest rate is now 6%. Someone rightfully said, well, hey, you're gonna have to sell this at a discount. This is how they define the discount. You will then take that bond, which is, I'm getting 5% on it, whatever that 5% coupon is. I think it was $100 I used, 5%, that'll be $5. So you got 3 annual flows of $5 going forward. You find the interest rate factor for that at 6%. The discount rate in this, even though the coupon is 5, the discount rate has changed. The discount rate, because rates have changed, now that's being discounted back at 6%, not 5%. So I find that factor. Then I take the $100 and discount that back at 6%, the lump sum payment. Now I got the price of the bond that the person should be willing to accept, or the person should be willing to pay. Okay, here we go, calculating the accrued interest. As the young lady said earlier, because I didn't hold the bond for the entire interest period, I'm only entitled to a portion. Going through this, they show you how to calculate that accrued interest, or it drives home the fact of the accrued interest a little bit more thoroughly. Okay? But the concept of accrued interest is still basically the same. Because I'm selling between interest dates, I am not entitled for the entire amount of the face value. Okay, we got about another 15 minutes. I want to see if we could quickly at least get through equities. Does anybody know what equity is? Lemon, just what does equity mean to you?
Can I assume that's ownership or capital? That's my
That's
interpretation.
correct. That's correct. That is absolutely correct. How does that compare to a bond?
Bond is a loan.
I'm sorry, could you repeat that?
Is it because the bond is essentially a loan?
That's correct. So if you bought a bond issued by a company versus equity issued by a company, when you buy the bond, you are making a loan to the company. When you buy equity, you are actually purchasing ownership in the company. Now, there are various types of equity. Let's start with preferred stock.
Can I be a bit facetious right here?
I'm sorry, could you repeat that?
Can I be a little devil's advocate?
Yeah, sure, by all means.
Do you really own it if they can buy back the stock from you?
Well, they cannot demand to buy the stock back from you unless they do a share purchase buyback.
Mm,
That has to be approved by the board of directors.
board.
Yeah.
So the board then really owns.
I'm sorry, could you be a little bit more? You don't have to be bashful, ma'am. We're all
I mean, if the board has the ultimate say, I mean, it sounds like they're the ultimate owner.
the board of directors are put in there basically for the protection of the shareholders.
Mm-hmm.
All right. So the board is appointed. Yes, the board makes decisions, but they're supposed to be making decisions that are based upon the best interest of the shareholders. That's what they really represent.
Okay.
Have there been times where there have been share buybacks? Yes, there have been times where a company would say, look here, we intend to buy back so many shares of our company. To make it equitable, those share buybacks are probably at a price higher than the current prevailing price of the stock in the market at that time.
Mm-hmm.
Okay?
Mm-hmm.
Why does the company buy back its shares? Well, it's healthy, it's making money. I want to reduce the ownership. So,
Right.
pardon me?
Right. Agreed.
So they're saying, like, let's say you opened up a shop. I don't know. You're selling a product or even a service you may be providing. In the beginning, you had to get up and go. Okay? So you were willing to sell a part ownership of your company. Okay? Now,
Mm-hmm.
during that time, whenever you made a profit or so forth, you paid it out to you paid it out in dividends to the shareholder. So the shareholders shared in the profits of the company, right? Now,
Yep.
in the meantime, let's just say your company did very well. You now have what you call retained earnings of the company, funds you held back. Now you come and say, okay, well, you know, I have granted when I needed the help, these people, the shareholders gave me the help, and I'm appreciative of that. But my company is to the point where it's healthy enough to carry on its own. And during the time my company was profitable, I shared my profits with the shareholders who loaned me their money or gave me their money. Now I am going to put forward a proposal to them to buy their stocks back. Now, the stock is currently selling in the marketplace $15. I am going to offer to buy back their shares at $20. Okay? We're trying to make it equitable to them. You ain't just want to say, oh, I ain't making money now. I ain't going to buy back the shares. Bye. See you all later. You're trying to make No, I mean, you got to make sure, because who knows in the future, you may have to go issue more stocks again, you know?
Mm-hmm. Mm-hmm.
So yes, it is an option. It can happen that way. Yes, ma'am. And it has happened before. Okay?
Mm-hmm.
And that is not easy to do. That's particularly in the States. Number one, they have to get approval by the board of directors. Okay? Number two, they got to get approval by the Securities Exchange Commission. So it ain't easy to just buy back the share. There's a lot of things, a lot of regulations they got to go through, but those regulations are designed to protect the interests of the shareholders.
Right.
But it can happen, okay? But I don't want you to believe it just can happen like, okay, I'm making some money, let me buy back the share. See you all later. No, no, no. You can pay some pain for that buyback. Believe you me, you can feel some pain for that. All right, does that answer your question, man?
It does. Thank you.
Preferred stock is a class of ownership in a corporation that has a higher claim on the assets and earnings of common stock. Preferred stock generally has a dividend that must be paid out before dividends to common stockholders, and the shares usually do not have voting rights. Preferred stock is almost like a hybrid between an equity and a bond. Because when you buy preferred stock, you have a stated annual coupon. At least you're going to earn. You're not going to only be relying upon dividend. So it's a hybrid. Quite often, preferred shares have provisions whereby if certain preset conditions are not met, then certain steps can be taken to better protect the preferred shareholders' interest. For example, the preferred shareholders can pick a member or members of the board of directors. Oh, that's another thing I forgot to mention. Stockholders vote in the board of directors. Some preferred stocks are perpetual, which means they do not have a maturity date, while others have a maturity date. A fixed rate perpetual preferred stock issue is an example of a perpetuity. The issuer of the preferred stock promises to pay a fixed amount every period, usually quarterly or semi-annually, forever. A fixed rate preferred stock with a maturity date is similar to a normal bond, other than having a lower claim on the assets and earnings of the company. Common stock. Common stock are units of ownership of a public corporation. Owners typically are entitled to vote on the selection of directors and other important matters, as well as to receive dividends on their holdings. In the event that a corporation is liquidated, the claims of secured and unsecured creditors and owners of bonds and preferred stock take precedence over the claims of those who own stock. Key ratios and descriptors used to evaluate common stock. You guys could read through that. As well as the key ratios. All right, wait. Let me just go over those. A 52-week high or low. This is simply the highest price and the lowest price at which a stock has closed over the last 52-week period. Year-to-date change. The dollar change in share price during the year since December 31st. That's the change in the share price. Year-to-date percentage change is just that percent stated as a percentage. Market cap. The share price multiplied by the total number of issued and outstanding shares of the company. Shares outstanding. Total number of issued and outstanding common shares. Float. Total number of shares that are outstanding and available for trading to the public. Short interest. Total number of shares that have been sold short and have not been purchased to close on the short position. Beta. The covariance of a stock in relation to the rest of the stock market. It is a measure of how a stock's price changes in relation to the overall changes in the value of the stock market. Anybody have any questions about any of those? Okay. Dividend yield equals the trailing 12-month dividend divided by the current stock's price. Earnings per share equals the trailing 12-month net income divided by the total number of issued and outstanding shares. Price to earnings ratio equals the price per share divided by the EPS. PEG ratio equals the PE ratio divided by the long-term earnings per share growth rate. Dividend payout ratio, the percentage of net income paid out in dividends. Okay, I'm going to stop there for the night because the next session is derivatives. Very, very simple. Can I get you guys to please read ahead and including derivatives, and all of portfolio management. I want to cover all of that in class 3. So class 4 is really left for economics. I only have 4 classes this week. Any questions about today? I will try my best to send you guys a step-by-step workout, particularly of question 23 during the course of the week. Okay. Any questions or comments, observations? I didn't even realize I had my video on.
I just had a question. Will we be working through all of the questions?
You mean the questions I gave you for homework?
Yes, sir.
I don't have a problem with that, but that is going to be on an agreed upon time outside of class time. It's just going to take too much of class time to absorb it.
Okay.
If you guys want to do that for 2 hours on a Saturday or a Sunday, I'll be more than happy to do it. But because of the time constraints with the class, the working through those problems could absorb a whole class session.
Will problems like that be on the exam?
That involved? Probably not. I mean,
Okay.
that's only now. I'm not saying that part of that problem may not be, because that's a very, very involved problem. And that is why I'm going to tell you, I won't do something like that, but I will tell you, I again encourage you to please get a financial calculator and become familiar with it. Any other questions, comments?
No, none for me.
Okay, well, guys, I know it's been a long day. I again respect your commitment to coming to class after a long day at work. I hope you enjoyed the second session as much as anyone can enjoy coming to class. I will now bid you a very good evening. Please enjoy the rest of your evening.
Same to you. Thank you.
Good night.
Good night.
Good night, good night.
Bye.